Many retail precious metals buyers refer to COMEX as the CRIMEX because they allegedly suppress precious metals prices. Well, in this video, we examine how this may be achievable, the cast of characters that would need to be involved, why they might want to do so, the math and models behind trading mechanisms, the concepts of stops, stop cascades, air pockets, puke points, registered versus available silver, or any precious metal, the threat of physical delivery, price decoupling, and eventual market breakage, and why silver would be the market to most likely effectuate it. Let's start here. If silver were being actively capped or simply structurally pressured lower, it would not require secret meetings. It would require understanding how modern derivatives markets actually function. Because silver is not primarily priced by coin shops, it is primarily priced by leverage. So we're going to examine this like a book. We're going to examine chapters, and so let's start with chapter 1, where price is actually formed. Paper silver price discovery flows through the COMEX, the CME group, which used to be the Chicago Mercantile Exchange, and the London Bullion Market Association. Physical flows increasingly reference the Shanghai Gold Exchange, or the SGE. The key structural fact, the volume of silver futures traded daily can represent a significant fraction of annual global mine production, which is roughly 800 to 850 million ounces per year. Most of those contracts never result in delivery, historically. They are rolled, closed, offset, financially settled, and that matters. Because when leverage dominates price discovery, price can move independently of physical tightness, temporarily. Chapter 2, the role of CTAs, or systemic money. So when silver rallies, one of the largest marginal buyers is not retail, it's systemic funds, commodity trading advisors, or CTAs. They don't make emotional decisions. They run trend models. These models commonly use moving average crossovers, breakout levels, volatility adjusted position sizing, momentum ranking, ATR-based stop systems. If silver breaks above a 200-day moving average, exposure increases. If it falls below volatility bands, exposure reduces. If it collapses through a trailing stop threshold, they exit automatically. And these systems are reflexive. They amplify trends. Chapter 3, how a stop cascade forms. This might look familiar to you. Now imagine silver is sitting just above a major technical support. Below that level sits retail stops, systemic volatility stops, CTA flip thresholds, dealer gamma hedges, and margin sensitivity. So liquidity, especially with silver, is thin. A large sell program enters. Price ticks lower. Support breaks. Stops trigger. Stop orders become market sells. Those sells push prices lower. More stops trigger. CTAs reduce exposure. Some flip short. Dealers hedge options exposure by selling futures. Volatility spikes. Exchanges may raise margin requirements. Highly leveraged longs are forced to liquidate. And this is the cascade. No conspiracy required, just structure and knowing how these models work. Chapter 4, air pockets and puke points. Pay attention here. An air pocket occurs when bids disappear. Order books can look deep, but during volatility, market makers widen spreads and pull size. So when stops hit, price gaps to the next real buyer. That gap is the air pocket. So got that? They use spoofs. The puke point is trader slang for capitulation. It's when leveraged longs give up entirely. In that case, you will see volume spikes, large range candle, open interest dropping, volatility peaking, and that is exhaustion. Once that happens, the weak hands are cleared and selling slows. That's when the shorts cover. Chapter 5. Could this be used intentionally? Well, if large trading desks understand CTA positioning density, volatility trigger zones, dealer gamma levels, and open interest concentrations, they don't need to crash a market. They simply need to push price towards fragile zones. The cascade does the rest. And so the incentives matter. Market makers prefer orderly markets, and they love clearing fees. Rapid upside volatility increases risk. Short-term capping during rallies can reduce balance sheet stress. And this is not proof of suppression. It's an explanation of leverage physics. It's theoretically possible. I'm not saying this happens, but theoretically, if this were to happen, this could be a way in which it could be done. Chapter 6, Risk Emergence. The system works until it doesn't, because most contracts are cash settled or rolled. But if too many participants demand delivery simultaneously, leverage collides with inventory. Western vault inventories categorized as registered represent metal eligible for delivery. If open interest remains large while registered inventories decline, confidence becomes the variable. And now we hit Chapter 7, the decoupling threat. If physical premiums begin rising above futures pricing, if the Shanghai Gold Exchange trades consistently at higher physical prices, metal flows east, where inventories tighten. And at some point, futures price may no longer represent the cost to actually acquire real physical metal. That is decoupling, and when that happens, repricing can be violent because leverage must reconcile with scarcity. And so, the final chapter, silver is a financialized commodity. Leverage accelerates moves in both directions. Cascades can look like manipulation. Sometimes they are simply structure interacting with positioning. The real stress point isn't daily volatility, it's delivery. And that brings us to March. Thank you for watching all the way to the end. As always, take care of yourselves and each other, and build that stack!